Good afternoon. This is Sean Golding with Golding and Golding, here to discuss the basics of passive foreign investment company taxation. Hope everyone had a good tax season. We get a lot of questions about passive foreign investment companies, otherwise known as PFICs. It's like a bad version of the telephone game. You've got some attorneys out there purporting to be specialists in international tax because they read a few posts. They get it wrong. They pass it to the next guy or gal. They get it wrong. They pass it on to the client. They get it wrong, and there you are. So we're just going to go through the basics. PFICs are passive foreign investment companies. The concept is if it's foreign and more than 50% of the assets or 75% of the income is passive, then generally it's going to be considered a PFIC. And when you think of PFIC and you think of company, a lot of people think, oh, they must have like a BVI holding company or a rental firm, a real estate rental firm, with a whole bunch of assets in it. But more often than not, that's not how it works. More often than not, Jane is a U.S. person and acquired some foreign mutual funds, ETFs, SICAVs, not knowing that since they're foreign mutual funds, they're normally individualized corporations and they get taxed under the PFIC regime. So when it comes to reporting, with PFICs, as with most international tax issues, there's the tax and then there's the reporting. From a reporting standpoint, even fractional ownership rules apply. So when you're looking up something like a 5471 for a foreign corporation, you have to own more than 10% or more than 50% CFC, et cetera, et cetera. When it comes to, and there's exceptions to that, right? But generally you have to have a certain ownership requirement with PFIC. It could be fractional ownership. If the value exceeds the threshold for reporting, then you have to report it. From a tax perspective, it works a little differently. So let's say you had a share of stock in a stock account, like an Ameritrade or something equivalent overseas, and your stock account, and it generated $5,000 worth of dividends. Well, whether you take those dividends out or not, they're still taxable. You accrued the income. It doesn't have to be distributed to you. It's still taxable. With PFIC, it's a little bit different. During the years it's accruing, you generally don't get taxed unless you made certain elections. But at the time it gets distributed, oftentimes what will happen is a lot of funds, whether you're redeeming the fund or dividends are issued later, once that first dividend comes out or the redemption, it's going to be for a significant value higher than the prior years. And most of the distributions are going to be excess distributions. Excess distributions get taxed at whatever the highest tax rate is for each year it was held within the. So you held it for 10 years and you're going back and you're doing the calculation. For each one of those years, you get taxed at the highest tax rate, typically 37% or 39.6%, and even different depending on how far you have to go back. And then there's a interest penalty for the time it was held in there. So where you might have a typical long-term capital gain that would get taxed at 15 or 20%, qualified dividend taxed at 15 or 20%, people are getting taxed 50, 60%, and it's totally unfair. So the idea is if you're out, if you don't have one yet, you may want to consider not getting one and getting a U.S. equivalent. Or if you just received it, or you want to make a cleansing election, you can make certain elections in order to avoid this kind of horrific tax situation. QEF, Qualified Electing Fund, MTM, Mark to Market, are two of the most common types of elections taxpayers make. If you make it in the first year, great. If you make it down the line, then unfortunately what happens is you also have to make a cleansing election, which means at the time you're making the election in the future, you also have to do the excess distribution at that time for the prior years in which you didn't do it. Completely unfair. A couple of different exceptions to consider. There's the treaty pension exception, which essentially says if you have your PFICs in a pension equivalent and it's with a treaty country, then you may not have to report the 8621 separately. I mean, you still do FBAR and FATCA Form 8938, but the hitch and the giddy up is that you may think it's pension, but really all it is it's like an insurance policy wrapper that is designed to sell you on retirement supplement later in life, but it's not really a pension plan per se. In addition, if you're an individual, it's $25,000. If you're married filing joint, it's $50,000. If you're below those thresholds and there's no excess distributions, you may not have to file the form. Unfortunately, there's more ambiguity because the instructions and the regulations conflict a little bit. You may have to report the first part of the form or maybe not. if you're out of compliance for passive foreign investment companies, then generally what will happen is, whether it's FBAR, FATCA, you have other issues, you would do one of the offshore tax disclosure programs in order to get into compliance. There's various different programs. VDP is the voluntary disclosure program, which is people for willful or can't certify under penalty of perjury that they're non-willful. If you're non-willful, you have a much bigger smorgasbord of things you could do. You've got the streamlined procedures, you got delinquency procedures, you have reasonable cause. We have lots of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's something we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.